Coming up in today's show, will China's slowing economy bring the US and the rest of the world down with it? Consumer sentiment comes in much higher than expected. Investors still pouring billions of dollars into the market. Meme stocks close out a huge week. JP Morgan significantly beats earnings estimates. And the US budget deficit blows out 64%. Hey, what's up everybody? Welcome back to the Click Capital Daily Show. My name's Jared, and I've got a good one for you today, so stick with me right through to the end and I'll get you up to date on all the latest news, data, and charts from the markets. And so it was a bit of a mixed day here to finish out the week on Wall Street. We did see healthcare have a bit of a bounce back today after being weak earlier in the week. Energy came off a bit today, and the mega cap tech stocks are still holding up pretty well. And since it's the end of the week, here's a look at the weekly performance. And we can see mega cap tech leading the way once again. NVDA up almost 7%, Oracle 4%, Adobe 6%, Microsoft 2%, Google 4%, Meta, Amazon, Tesla all did well too, along with a bit of bullish breadth across the market. And so the most significant economic data point we got out today was the Michigan Consumer Sentiment Survey, in which they take a sample of Americans all across the country and ask them 50 core questions about how they feel about their own personal finances, the economy, and their future expectations. And so that was expected to come in at 65.5, actually beat significantly, coming in at 72.6. And here's a look at an 8-year chart of the Consumer Sentiment Survey. And you can see that came in with what looks like to be the biggest beat on record and seems to have bottomed out in June last year at 50. But still nowhere near back to pre-COVID levels, up around 100 and between 90 and 100, which it had been for a couple of years before that. So according to that survey, Americans haven't felt this good about the economy in almost 2 years. And that probably has a lot to do with the tight jobs market, a stock market that's been performing well, and inflation on the downtrend. So the real question is this a temporary bump up or the start of a new secular bull market? And there's no shortage of new bulls to the party, with investors pouring in $12 billion into stocks in the last week, as there's now a big expectation that the Fed is almost done on rate hikes with only one more left in the bag, on the basis that they've achieved their inflation goals and that inflation should still keep ticking down towards their 2% target. And so it's that Goldilocks scenario that the market is getting excited about, with the economy holding up, unemployment remaining low, and inflation coming down. That's why we've even got respectable investors like the Big Short investor Steve Eisman saying stocks will keep rallying as long as the economy stays healthy. And he doesn't think investors will sell their stocks as long as the economy holds up, because he said the Fed keeps raising rates, it hasn't had an impact. Until it has an impact, we'll keep chugging along. He did go on to say, I'm surprised how much the market has gone up this year, and saying that the data is still very strong and the Fed raising rates just hasn't had an impact. He's focusing investments in tech and infrastructure while avoiding bank stocks following the turmoil earlier this year, and said the regionals are still problematic because they keep losing deposits and have to keep reducing their balance sheets. And that sustained market optimism starting to get a little frothy now, and we can see that spill over into the meme space, which have been doing really well of late, with some of them seeming to come back from the dead like Carvana and Nikola. However, don't forget, when meme stocks get overbought, that can be a bad omen for the market, as typically meme stocks are late to the party. And we can see that in this chart here with 7 of the most popular meme stocks: GameStop, AMC, Coinbase, Palantir, Carvana, Beyond Meat, and Kodak, represented by these dots on the chart when their Z score gets above 3. That means when they go more than 3 standard deviations above their mean. And we can see those clustering of dots coincides with short-term market tops in the S&P 500. And that's what we're getting now. Similar to other sentiment indicators, we're getting quite the clustering of overbought signals. And a very successful hedge fund manager of late says the S&P 500 is entering into no man's land. And that's Peconic Partners hedge fund, with their assets ballooning thanks to a near perfect run of market timing that included shorting last year's bear market and pivoting long just as the tide turned. The hedge fund was up 26% last year and is up 35% this year. And they're saying that the tech rally that helped fuel the last leg up has seen its best days. They dumped all their shares in Alphabet and Amazon, and bracing for slower times ahead as $9 trillion has been added to the stock market in the last 9 months. And they're saying they're having trouble seeing where the next big growth is going to come from. But as it currently stands, we still have an economy that is doing well, and we can see that in the earnings from JP Morgan, with their revenues rising 34% as they took advantage of higher rates and solid loan growth. The earnings came in at $4.37 a share versus $4 that was expected, and significant beat on revenue, $42 billion versus $38. Their net income surged 67%, and they also did that really favorable government brokered takeover of First Republic. CEO Jamie Dimon said the US economy continues to be resilient, consumer balance sheets remain healthy, and consumers are spending, although a little more slowly, and labour markets have softened somewhat, but job growth remains strong. Also got earnings out from Citigroup. They didn't do as well as JP Morgan. Their revenue fell 1% from a year ago, but they beat on earnings a little bit, $1.33 versus $1.30. Similar story from Wells Fargo earnings today. They beat on the top and bottom line, $1.25 in earnings versus $1.16 expected, and that was helped a lot by higher interest rates, with their net interest income rising 29%. And here's a quick look at the price action in the financial sector fund ETF today. We gapped up, finished lower than yesterday's low, giving us a bearish engulfing pattern. JP Morgan was the best performing bank out of them all. Gapped off, sold off a bit, but still finished higher than yesterday's close. Similar pattern in Wells, but finished a bit weaker, and Citigroup was the worst performer, finishing really weak, a bit below its 50-day VWAP. We also just got a report from the International Monetary Fund, which studies the world's economies and gives advice and guidance. And their headline was weak global economy, high inflation, and rising fragmentation demand strong G20 action. Their outlook was resilience amid challenges. In April, they projected global growth at 2.8% in 2023. Down from 3.4% in 2022, with the bulk of it over 70% expected to come from the Asia-Pacific region. However, recent high-frequency indicators paint a mixed picture: weakness in the manufacturing, contrast with resilience in services across G20 countries, and strong labour markets in advanced economies. They're claiming global headline inflation seems to have peaked and core inflation has eased somewhat, but in most G20 countries, especially advanced economies, inflation remains well above central bank targets. And we can see that in this chart here, with the red dots representing the inflation target of central banks around the world. With the top up here, the G20 advanced nations, you can see most of them have a 2% target, and then emerging countries are actually more comfortable with higher targets around 3-4%. So basically around the world, we've only got 3 countries with their core inflation below target, and that is China, with on the verge of deflation with the weakest economy, Russia not too far behind them, and Saudi Arabia. All other advanced economies have inflation still well above target. And so one of the biggest developing stories in financial markets is solid signs that the Chinese economy is not recovering as expected, and things are a bit weaker over there than most people realize and that they've been letting on. However, recent signs have shown that they're finally coming clean about their economy, and the CCP is allowing country economists and the media to openly talk about it, as normally it's a dangerous subject to speak negative in any way, shape or form about the Chinese economy. However, we've got China's new premier now heading a high-level gathering of the country's leading economists, and he said China's facing a critical stage in an attempt to recover and must spare no time in implementing a batch of targeted policies. They admit now there's a consensus among everyone that the recovery is below expectations, and they said there's signs of an economic downturn starting in the second quarter of this year that indicates risk may be spreading and expanding. And so for a world that's largely in sync, we've had this persistent inflation across the world now for a little while. The Chinese economy is pulling back so sharply that they're almost on the brink of deflation. And like this article says here, it could be a huge red flag for the global economy. And they've already responded to that by cutting all of their key interest rates. So we're seeing a real divergence now in the world's 2 largest economies. In the US, the economy is holding up pretty good with low unemployment and still high inflation. Now we've got pretty much the opposite in China, where prices have fallen so quickly they're on the verge of deflation, and they've got high unemployment, especially in the young. And so while that should help inflation in developed economies with prices coming down in China, it could also make it hard for us to avoid a global recession when we've already got the Eurozone technically in a recession, Japan flirting with one, China looks to be in one now, and the 4th and largest remaining economic center in the world, North America, would truly be a Goldilocks scenario if they do avoid one. And part of China's weakness can be attributed to the West's withdrawal from China and diversifying their supply chains after COVID, and we can see that in China's exports falling the most in 3 years. And that was much worse than expected, falling 12.4% year over year in June, and that was following a drop of 7.5% in May, so that looks to be accelerating on the downside. And we can see that in this chart here, also with their imports in a downtrend as well. But if there's ever a country that knows how to shoot themselves in the foot, almost as good as Russia, it is China, as they continue to ramp up the economic Cold War with the West by restricting 2 metals crucial to making semiconductors. And because dictators hate democracy and love the company of each other, we're seeing a similar story in Russia with their economy going down the toilet as well. And we can see that with their trade surplus tanking 93% last quarter year over year, and that's because the West has got heavy sanctions on them and a price cap on what they can sell oil for, $60 a barrel, to limit their revenues and also help keep a lid on our inflation. So in this ongoing proxy war in Ukraine and the economic Cold War of essentially democracy versus autocracy, so far the dictators look to be losing. And so we can see that China deleveraging trend across the world now, with the Europeans jumping more on board. And we've just had Germany urging their companies to de-risk from China, but pulling up short of saying they're seeking a full decoupling. Like other Western countries so far, just de-risking, deleveraging. However, when China moves to take Taiwan by force, we may see a full-on decoupling. And so it may not be a deglobalization that we've seen, but rather a reglobalization and kind of different makeup of the world going forward. And we can already see that with news that Mexico has replaced China as America's top trade partner and how it's forging new relationships going forward. So basically the world wants to rely less on China to make all those goods, and you're going to see other countries replace them like Mexico, India, Indonesia, Brazil, and others. And so China, who had been on a 2-year-long crackdown on their big tech companies as they got highly insecure at how big and concentrated they had been, and they looked over to America and worried what was happening with mega cap tech's dominance and influence on politics and culture. In America and other Western economies, they didn't want the same thing to happen to theirs. So they put a strong thumb over top of the tech companies, and even some of the biggest and best, like Jack Ma, went missing and is apparently still exiled in Japan. We may now be seeing the CCP turn that around and are now meeting with the tech giants and want them to support the economy and may hold back from fining them and limiting their ability to grow. And that may be why we're seeing a little bit of a bounce up here in Alibaba, and there has been some unusual call option activity in the stock as well. However, just taking you out to a monthly chart, still well off its highs at 319. Back in October 2020. And so as China's seen a lot of trade relationships disappear, they're also seeing investor capital disappear, which is the foundation of all economic growth. And so they're scrambling to turn the tables on this quickly by inviting global investors for a rare meeting. And so China's financial regulators are reaching out to investors to try and invite them back to the market to invest. However, with the nearby prospect of them invading Taiwan, I'm not sure how many big investors want to risk their money there, not only with the CCP being able to change the rules, but also possible Western sanctions. And even though there is some great valuations over there, I for one won't be investing anything over there for some time. In other news out today, we saw that US budget deficit ballooned $2.3 trillion in the 12 months through June. That's a 64% jump from fiscal year 2022. According to this article, the government is burning cash like a drunken sailor, and former Treasury Secretary Larry Summers says it's completely unsustainable. And like it says here, this is occurring when the economy is still in an expansion with the unemployment rate near a 54-year low at 3.6%. What happens to the deficit when a recession hits? Because typically in a recession, corporate earnings and personal income goes down, so does the tax the government receives. And ideally, to get the economy out of a recession, the government likes to increase spending, start new infrastructure projects, etc. However, with public debt already at huge levels, that may be politically impossible to achieve. We also got the CEO of the largest asset manager in the world, Larry Fink of BlackRock, saying US debt is out of control, but he said an accelerating economy can help solve that problem. We now got national debt over $32 trillion, but he reckons GDP growth of 3% or more could help that. And of course, it's just like your personal finances. If you've got a great job or business and that's growing, then you can keep borrowing. The problem comes is if that growth stops or even reverses. The largest private company in the world just got even more valuable. SpaceX now got a valuation of $150 billion after their latest round of financing. Still no confirmation on when it's going to IPO. Elon has hinted it may come in 2025, and this will be the world's biggest IPO ever. I mean, in the secondary market, it's already got a valuation bigger than Boeing and all the other big military stocks. And this is thanks largely to Starlink, which is already cash flow positive, and SpaceX has a near monopoly on satellite launches, already done over 5,000. So that should be huge when it finally does hit the market. We've got Fed Fund futures pricing in a near certainty the Fed's going to hike later on this month, but the chance we'll get a second hike in September is still only a low 13.5%. And that's why the market has been getting excited, because the prospect of only one more rate hike. And that's why we've got that persistently high reading in the fear and greed index at 80. And we've been in this extreme greed zone now for over a month. Massive day on the options market to finish out the week. 47.5 million contracts traded, with a whopping 60% of them being call options. And there once again is that unusual call option activity in Alibaba. 302,000 contracts traded versus 53,000 puts. And a little bump up in the dark pool buying index today to 49%, but still on a bit of a divergence here from the market. And corporate insiders have been on holiday as of late, as they haven't been doing much trading, and it was yesterday that we got in data showing 11 purchases, which have been the lowest reading all year, and the amount of corporate insiders buying their stock. Okay, back into the charts, and the S&P 500 actually found new year-to-date highs today at 45.27. Before we closed a little bit lower than yesterday on basically a flat day. Same with the Nasdaq. Little inverted hammer, shooting star formation, still too early to call it a top. But there was a bit of weakness in the breadth of the market. International stock indices were a little soft as well. No surprise that the VIX finished down on Friday to 13.3, and there's the skew jumping again to 149. price of out-of-the-money put options continuing to trend higher. We've had this improving breadth of late with 82% of stocks above their 50-day average, 66% of stocks above their long-term 200-day average. That's still below the February 2nd peak where we got up to 76%. A little bit of a pullback in the growth versus defensive sectors. Same with high beta stocks versus low volatility after we've been on a great run since May. But growth versus value still breaking out in a strong uptrend. There's small caps versus large caps just kind of hanging in there. And a little bit of a bump up in the government bond yields today. The 2-year at 477. Dollar index dived this week to under 100, lost that big key support level. As that lower than expected CPI number caused financial markets to price in the lower odds of the Fed hiking again in September, which caused yields to fall and a bit of an exodus in the dollar. Although that didn't really help Bitcoin, even though we had news yesterday of the cryptocurrency Ripple getting a favorable judgment in their case with the SEC suing them, saying they were selling an illegal security. We did get an initial pop-up in Bitcoin and broke out of this consolidation level, but has just been rejected and sold off really hard. So looking at that 4-hour chart of Bitcoin, every time we rip up above 31,000, there seems to be sellers step in and take it back off. So there seems to be an equal amount of bulls and bears at Bitcoin just above 30,000 here. And that weaker dollar has helped commodities rally up this week with a bit of a bid in gold. And we'll see whether this can hold onto its 50-day VWAP and come up and test new all-time highs again soon. Crude had a good week as well, but pulled back a little bit today to above 75 a barrel. And over to stock sectors, mostly red out there with a few spots of green. In home builders, which have been on an absolute tear, and a few of the defensive sectors came back like healthcare, which had been weak recently, and staples. And just a look at our sector trends table, we can see we're still mostly green across the board. Just a little bit of red up the front in energy, retail, clean energy, and jets, which have been doing really well lately. And basically all sectors still above their 20-day and 50-day moving average. There's BlackRock with their earnings out today. They beat by a little bit as well. However, like the other banks, we put in a bit of a bearish engulfing candle as we had a nice rally going into them. Also got ExxonMobil breaking down, coming back down to their March support. And mega cap tech still holding up really well with Apple and Microsoft nearing highs. Google bouncing back, Amazon breaking out to new year-to-date highs. We got that breakout in NVDA and actually found 480 today, but did a strong inverted hammock formation. Tesla found new year-to-date highs as well at 285 today. Got earnings coming out in that next week. That'll be a big one. Meta still chugging along, and same with Netflix. Meme stocks had a good week, but came off a bit today. A bit of red across the board there. Coinbase had a huge day yesterday, ripping up above 100. Looks really technically overbought here. Carvana as well may see a pullback next week. Also had earnings out today from United Health, got a slight beat, and the market loved that. And that price action in the big banks spilled over to the regionals as well. They all came off a little bit today. And we've got the others like Charles Schwab and most of those other regionals reporting next week. Let's look at our S&P 500 oscillator, currently at 58.27 and still on a bearish divergence with the market. And so that wraps out the week. Pretty much same story as it has been the last couple of months, still in this tight parabolic uptrend. The market's still going for that Goldilocks scenario of continued economic growth and decreasing inflation, even though we've got much of the rest of the world already technically in a recession with still high inflation, bar China, because their economy is coming off a lot faster than expected. And so I would say it'd be truly remarkable if America and some other Western economies can escape what's going on in China. Just because China is so big now, it has to have an influence on the other markets. So I guess the question now is the likely big stimulus package going to come out of China. Is that really going to work? And is it going to work quick enough to get their economy inflating again and avoid deflation? So I guess time will tell with that one over the next couple of months. But for now, the focus will be on continuing Q2 earnings season, getting into the thick of it over the next week or two. But so far, so good with the big banks coming out today beating, and optimism and sentiment in the stock market continues to remain near all-time highs with strong momentum and price action. And so the market's going to need a real shock and surprise and vicious down move to change all of that. Until then, it could keep ticking higher until we get some surprise like that. That's all for this week. Thanks very much for sticking with Click Capital. I truly appreciate you. I hope you all have a great weekend, and we'll see you again Monday afternoon. Cheers.